All right, today we're doing something a little different. We're not just going to talk about trading theory. We're actually going to build a professional trading strategy right from the ground up, looking at its architectural blueprint. We're going to combine a really powerful institutional concept with an intelligent filter to engineer a system that's all about efficiency and quality.
So let me ask you this. How do you actually follow the smart money? What are those little breadcrumbs, those footprints that big institutions leave behind in the charts? Well, the answer isn't some super secret formula. It's all about spotting specific inefficiencies in the market. And today, we're going to show you exactly what to look for.
So here's the game plan. We'll start with the heart of it all, the institutional concept of the fair value gap. Then we'll layer on a smart filter with a moving average. From there, we'll get into the professional engineering behind it, the multi-time frame system. And finally, see how it stacks up against the old-school methods before we wrap up. Let's dive in.
Okay, let's start with the absolute foundation. The entire core of this strategy is built on what's known as smart money concepts, basically a way of thinking that focuses on trading alongside the big market movers. And the key idea, the pillar we're building on, is the fair value gap, or FVG for short.
So what in the world is a fair value gap? Well, think of it as an imbalance, an area of inefficiency. It happens when price just rockets in one direction so fast that it leaves a literal gap between the wicks of the candles. It's a zone where price wasn't traded fairly, and more often than not, the market wants to circle back to fill it. And that is where our opportunity lies.
Now, these gaps, they come in two flavors, right? A bullish FVG shows up as a gap below the price, and it acts like a future support level. Then you have the bearish FVG, which is a gap above the price, and that creates a potential resistance level. You can really think of them as magnets that pull the price back to them. But why on earth does this actually work? Is it some kind of market magic? Nope, not at all. It's pure market mechanics. You see, the big institutional players, they use these exact zones to build up their huge positions, to find liquidity, and even to protect their existing orders. So when we spot these gaps, we're literally following the footprints of smart money.
Okay, so having a great concept is fantastic, but we need a way to filter out the noise, right? We need to add a layer of efficiency. And this is where the moving average comes in. But we're not using it as a simple lagging indicator, we're using it as a traffic controller for our trades.
And check this out, here's the rule. It is so simple, but it is incredibly powerful. We only entertain the idea of a buy when the price is trading below the moving average, and we only look for sells when it's above. This one little filter stops us from making classic mistakes like buying at the top or selling at the bottom. It just forces us to focus on high probability pullbacks. It's a massive boost to efficiency. So let's really dig into the why here. How does this work? Well, when the price is below the moving average, we're basically waiting for it to pull back up to a bullish FVG, which acts as support. When the price is above the MA, we're waiting for it to pull back down into a bearish FVG, which acts as resistance. We're combining two powerful ideas, mean reversion and structural imbalances. And it's that confluence that makes the setup so efficient.
All right, now we're getting into the really cool part, the actual engineering of the strategy. This is where we take a good idea and turn it into a truly robust, high-quality trading system. It's about building a machine that doesn't just work, but is designed to be tough and easy to manage. That right there is the hallmark of professional quality.
So because of this professional design, we get some major advantages. First, we're dealing with high-probability setups. Then, there's an intelligent recovery system built right in for when things don't go perfectly. All of this is controlled by some advanced risk management, and it's all wrapped up in a system that's really flexible. Let's zoom in on that risk management part for a second.
Look, any truly professional strategy has to be built with safety in mind. It needs a solid defense. Here, you've got a configurable stop loss protecting every single position, a global profit target that automatically cashes out gains, and a limit on recovery orders to make sure you never have too much exposure. It's a complete safety net.
Okay, you ready to add another layer of precision? This is where we bring in the multi-time frame system. The whole goal here is to cross-check our signals from a few different angles, which just dramatically boosts the accuracy and the quality of our entries.
And this is how it works. It's a top-down approach, like a cascade. We start high on the 30-minute chart just to get a feel for the bigger picture trend. Then we drop down to the 15-minute chart to confirm that our bias is correct. And only when those two line up do we go down to the 5-minute chart to look for that perfect entry trigger. This makes sure we're always swimming with the current, not against it.
And when you do this, the benefits are just crystal clear. You get this powerful cross-validation of your FVG zones, which gives you way more confidence.
Your timing for entries gets so much better. And because the whole structure is so sound, you can apply this to almost anything. Forex, indices, you name it.
So the big question is, how does all of this stack up against the old-school conventional methods? Let's put them head-to-head, because I think you'll see there's a really clear advantage in the design and efficiency here.
Honestly, the difference is night and day. Traditional strategies rely on lagging indicators that are always a step behind. We're using proactive inefficiency zones. They use arbitrary stop losses. Our stops are based on actual market structure. They get tangled up in a mess of conflicting trend indicators. We use the MA as one simple, clean filter. This isn't just a small improvement, it's a total upgrade in how you approach the market.
Okay, let's wrap this all up. At the end of the day, what does this strategy actually deliver? When you implement a system with this level of professional design and this focus on efficiency, what can you really expect?
So, what should you remember from all this? Well, you can expect much more precise entries that are right in line with institutional levels. You're going to see way fewer false signals because that MA filter just cuts through all the noise. The system itself is built to automatically handle drawdowns, and overall, it just gives you a much simpler, more automated way to manage your trades.
And I think this quote really says it all. The strategy combines the raw power of institutional concepts with the beautiful simplicity of a moving average. It's that smart blend of sophistication and efficiency that creates such a high-probability system and really gives it that professional-grade quality.
Which leaves us with one final big question. When you merge these institutional-grade concepts with intelligent filters and professional-level risk management, are you looking at the new frontier of efficiency in trading? It definitely makes a strong case for a smarter, more quality-driven way to trade.